Hi everyone. Today I want to show you the use of PMT function in Excel to calculate the amount of monthly loan payments. Most of the loans between the businesses or made by the businesses to the individual borrowers are fully amortized. What fully amortized means is loans where the monthly payments made over the term of the loan pay off the principal and all the accrued interest. In Excel, you can calculate the monthly payments required to pay off a fully amortized loan using the PMT function. In this video, I will show you how to calculate those payments. To calculate the monthly payment on the loan, you need to know a number of things. First is the rate of interest on the loan, and you can find that here in cell C3. Next, you need to know the number of payments you're going to make per year, called the periods per year, and I have that in C4. The number 12 refers to a monthly cycle, but you could also pay quarterly. In that case, you would have 4 payments to make in a year. Semi-annually means 2 payments per year and annually means 1. Next, you need to know the total number of payments. In this case, we'll have 60. So 60 divided by 12 gives you 5. So you know the loan will be paid off over 5 years. And then you have the last mandatory element, which is the present value. That's simply the amount of money that you are receiving for the loan. So that's $4 million. The next two items are optional, that is the future value. And the future value might be the money that you have not repaid at the end of the loan. So for example, the future value of the loan could be $1 million, meaning that at the end of the loan, you have $1 million balloon payment. The final item, type, indicates when the loan payment occurs, where at the beginning of the period, that is beginning of the month, or at the end of the month. Most of the common type of loan is to pay at the end of the period, and that is type 0. If your payment is due at the beginning, then it's type 1. Future value and type are not required, they are optional arguments, but I wanted to list them here in case you need them. Now I'll go down to cell C10 and create a formula to calculate the payment. So I'll type in an equal sign followed by the PMT function, left parenthesis, and you can see my list of arguments. The first is the rate, and we are going to divide that by the number of payments per year or number of periods per year, because 8% is an annual rate, comma, and so you'll divide C4 and then comma. Next is the total number of periods, that is C5, then a comma, and the present value, the amount you're borrowing, C6, then comma, and then future value is in cell C7, comma, and then the type, we are going to assume that we are going to make payments at the end of the period, so type 0, right parenthesis, and enter. And I see that the payment is $81,105.58 per month. Note that this is a negative value, and the reason it's negative is because it's a cash outflow. It's the money that's leaving your account. If you, like many people, want to see the payment as positive number, you can change the formula by putting a minus sign in front of the PMT function. You can do that by going into the formula here and putting a negative sign in front of it. One thing to note is that the PMT function only calculates a monthly payment that covers principal and interest. Many loans have other charges included, such as property taxes and insurance. So be sure to include those other fees and charges when you calculate your loan payments. Thanks.